Joining us now for the first of 5 consecutive appearances all week long here on the agenda, Paul Summerville. He is Senior Fellow at the Center for Global Studies at the University of Victoria and the former Chief Economist at RBC Capital. And I guess most wonderfully for our purposes, this is your first time on television in how long?
In 4 years.
In 4 years. Where was your last appearance on television?
Well, when I was running for the NDP in the federal election of January 2006, with Carolyn Bennett and Peter Kent. We were running in St. Paul's.
Which is this riding right here?
Right here, and you got us all around a table, and you got us to talk a lot about what we believe.
It's actually just right over there.
Right over there on that desk over there. It was a lot of fun.
Well, your return to these parts is long overdue, and we're very glad to have you back here, Paul.
Nice to be here. I look forward to chatting.
So, of course, the G8 and the G20 is just finished. Finance is quite naturally top of mind for a lot of people. We want to spend much of our time this week reimagining what the economy could be like. And just, I guess before we start talking about today, we do want to go out back and do a bit of a history lesson here. Financial innovations of the 20th century.
Yes.
And we really want to go back, focusing first of all on banks and how banks began to lend money. How did all of that change? Let's go to the first half of the 20th century.
Right.
Start there.
Well, first of all, let's just step back and remember that when we talk about changes in finance, we're talking about technology. And the way I like to describe some of the risks around that is to think about the automobile. So when the automobile was invented and mass-produced in the 1920s, the intended consequence was that it got you from point A to point B in a pretty quick period of time. But the unintended consequences included that it killed and maimed people. That by the 1960s, it created a lot of environmental problems, bad air, Los Angeles, that kind of thing. That the car has created great sprawl in cities. Some people would say that what we're seeing in the Gulf, we've seen, is a consequence of a car culture. So technologies have intended and unintended consequences.
And the same in banking as well.
And the same applies to financial services. So when we think about what banks did, particularly in the big explosion of banks in the 1920s in North America, but also in Europe, the function was a bank to basically take someone's money and then lend it out to other people. So take people who didn't really need their money, offer some kind of interest rate in return, and then hand it out to people who wanted to buy a house, buy a car, build a business. That intended consequence worked very well, and the 1920s are remembered for being very successful economically.
Was that considered a major innovation at the time?
Yes.
Taking in money and lending it out?
Well, no, it was there was an evolution in the distribution of that opportunity. So I think you've had Neil Ferguson on your show.
Yep.
The best book is his, The Ascent of Money, where he talks about that it really began in the 7th century. But it gained great momentum in the 1920s, partly because of other changes in technologies, the telegraph, the ability to make proper accounting and this kind of thing. So there are other technologies that supported the explosion in banking.
So the unintended consequence then of that was?
Well, the unintended consequence was 2 things. One, that Paul's bank, right, where I offered you 6% on your deposit, when the bank down the street, maybe Wells Fargo for sake of argument, was offering 2%. Well, you walked in and gave me your money because I gave you 6%. What you didn't realize was that what I was doing with your money was lending it to people who were investing in the stock market. That it was being used for very speculative kinds of lending. Or that I was taking $1 of deposit, and instead of lending out maybe 10 times, I was lending out 100 times. So the risk that the bank would go down, and hundreds and thousands of banks went down between 1920 and 1932, was the unintended consequence of that lending.
And probably when I gave you my money, I didn't know you were doing that with my money.
You didn't think to ask. You didn't know. And that's not much different than what we saw in the last couple of years. A lot of people didn't understand what financial institutions were doing their money, how they were investing it. So the unintended consequences of financial technology are a huge issue. And the question is, how do you regulate that? So fast forward to the last decade. And the major innovation that occurred was something called securitization. And basically what happened was that a bank would take a whole bunch of mortgages, and instead of keeping it on their balance sheet, they would package it into a bond, because as an investor you wanted a regular flow of income from that bond, because those mortgages were, monthly payments were coming in from families. So I packaged that and I gave that to you. The thing was, how and were you able to buy it? You'd only be able to buy it and put it on your balance sheet, say as an insurance company or as an investor, depending on how it was rated. If it was rated single A, you probably couldn't buy it. But if it was rated triple A, you would be able to. Mm-hmm. And this, of course, is where the rating agencies come in. So the rating agencies, using models which now are highly discredited, because the unintended consequence was that the underlying mortgages actually were being held by people who really couldn't afford a home, really had no business having a mortgage in the first place. And so you had what you thought was a triple A rated bond, when in fact it wasn't that at all.
So you're painting a picture of banks that are doing things with my money that they shouldn't be doing. They are wrapping things up with the good housekeeping seal of approval from credit agencies who really don't know what they're doing. They're giving them a good housekeeping seal of approval when they shouldn't be, and then sending it somewhere, and the folks who are buying it, they're buying a pig in a poke, in effect.
Well, there was a conceit, and the conceit was there were two parts of this conceit. The first was that the housing market, and we're talking about the United States now, never went down. That there would never be a national decline in housing prices, which would then expose the underlying value of these bonds, which were mortgages. And even though that had happened before, it had happened in the 1930s. It had happened in Japan, a country I spent a lot of time in the 1990s, and it continues to happen. So deflation in housing is not something that's never happened before, but there was a general belief that it wouldn't happen in the United States. The second issue was the models that were used to price these securities. And increasingly, in order to justify the explosion in the value of these securities and the numbers that were sliced and diced and handed around, was the models that essentially predicted that the risk of default was very, very low. Mm-hmm. And so compliance managers and investors were persuaded by the AAA ratings that these bonds had that everything was going to be okay. Mm-hmm. In fact, the models didn't work, and the housing market went down, and that was the recipe for catastrophe.
For disaster. I was thinking about this morning because you just gave the analogy of the unintended and intended consequences of the automobile industry. And I want to talk to you about derivatives right now.
Sure.
And I was thinking this morning, I've been watching baseball for probably 40 years.
Right.
And I know a balk when I see it. When a pitcher balks, I know it when I see it.
Well, yeah.
But if I was going to describe that to somebody else, I'd have a hell of a time describing what a balk is, Mm-hmm. Okay, Paul, what's a derivative? I mean, I think I know what it is, but I'd have a heck of a time trying to explain what it is. What's a derivative?
It's rooted in the word. So it's a derivative is something that's made of other things.
It derives from something else.
It derives from something else. So again, if we go back to this idea of securitization, what I do is, I have your mortgage, and I have this cameraman's mortgage, and I have the person down the street's mortgage, mm-hmm. and I have 100,000 mortgages, sitting on my balance sheet. I derive a bond by taking all of those 100,000 mortgages and creating something else, and I call it the wonderful bond that you should buy because you have a regular income and you don't have to worry about more than a small percentage of these mortgages being
Seems like
default.
a long name for it.
Well, you'd be surprised in some of the names that these things were given. But the point is, it derives from something else, and then it's traded. So you actually have to put a price on it, and that, of course, is where a lot of the trouble came.
Okay, so hold on. You take all these mortgages,
right?
You securitize them, right? You wrap them all up in a new thing, a new bond.
Thing. That's right.
Okay, and then it's on your balance sheet. You own it.
And then you
Pick
can
up the story.
Well, you can hold on to it and continue to enjoy the revenue that comes in.
Some kind of steady stream of income.
You can take a second one and you can put the two of them together, which is called a synthetic credit default debt obligation. So put those two together. That is called something else. You can start to differentiate the types of mortgages, whether they're subprime, whether there's a better chance that mortgage in fact is going to be paid out, and that then can be sold to somebody else.
So there's innumerable kinds of financial instruments that.
Well, it's the leverage. So you begin with a pool of mortgages, which are mortgages, mm-hmm. and then the greed sets in, the opportunity sets in, which is young, really smart Ph.D.s for the most part, highly trained in mathematics, who are able to create a derivative out of this pool of mortgages and then price them and sell them to investors in the secondary market between themselves and other participants.
Okay, primary versus secondary market. You want to explain
Primary
the
is when you first issue something. So, for example, when a company, like Sears, wants to raise money, they'll go into the primary market. It'll be the first time they issue a bond or an equity. Then, once that's been issued, the people that bought it, then they trade it, and that's called the secondary market.
Secondary market.
So what happened was that the derivatives were created in the primary market, and then they were traded and sold among other investors. Particularly, and it's very important to remember in the context of very low interest rates. And this is why a lot of this has fallen to the feet of Alan Greenspan, because the Fed kept interest rates very low, and if you're a pension fund and you have certain kinds of liabilities that you have to meet, getting any kind of bond that would have a higher level of interest would encourage you to buy that product. And so part of the environment that created the oxygen for these things to be created and traded so rapidly to such a huge volume by the time we got to 2006, 2007, was the interest rate environment within which companies were operating. They were desperate for yield. So companies were chasing yield. So when I came along and, or a salesman of these products came along and said, okay, U.S. Treasury 10-year bond is say 3%, we can offer you, 5.5% on this CDO.
Take that.
Wave it in.
Yeah.
Particularly, and very importantly, when it has a AAA rating, and when your own people, I mean, it's not like people were totally blind, when people were convinced that the models behind the derivative would guarantee that they wouldn't default.
And I guess if they're all wrapped up in mortgages, as long as the price of houses keeps going up and the market keeps ballooning and ballooning,
well, this was
it all sustains it.
This was part of the unsustainability of the sustainability.
Okay. How about credit default swaps? Want to give us your best definition of what a credit default swap is?
Well, the key for anyone trying to understand this, I think professionals in the business, never mind laymen, is to replace the word swap for insurance. It's really credit default insurance. And what happened, the way it began, was people who weren't convinced that the housing prices were not vulnerable. So people who were confident that housing prices were going to come down, and were very concerned about the types of mortgages, these subprime mortgages, that were being given to people who had no income, had no credit, had no business having them, and were really fooled into taking mortgages with teaser rates. So I would be offered by a mortgage broker $500,000 mortgage on a $500,000 home, where my annual interest rate for the first 2 years was 2%. But after the second year, it went up to 12. So if you were pretty convinced that the housing market wasn't going to continue to appreciate in value, then that meant that when that interest rate shifted from 2 to 12, that those people would be in a lot of trouble. Because the only way you could afford the shift from 2 to 12 is if housing prices continue to rise. Right. So what happened was, and there are lots of stories about this now, a bunch of smart people said, well, go over to see Deutsche Bank. Go over to see Goldman Sachs. We're full of these really, really smart people. Can you put together for me an insurance policy? And this is the way it works. I think the market's going to go down. I'm absolutely confident that the housing market in the U.S. has to go down, and it's going to expose all these terrible mortgages, and a whole bunch of people are going to default. Particularly in the United States, where the bankruptcy laws work that you're not on the hook when your mortgage blows up. You just put in the key and send it back. So these hedge funds went to see Goldman and Deutsche and others and said, can you put together for me a pool of mortgages that you think are actually going to blow up? And I'm prepared to pay you, if you're prepared to take the risk, and let's say the total value of the mortgage is $2 billion, right? If you're prepared to take the risk to pay me $2 billion if these things default, I'm prepared to pay you on a monthly basis, I don't know, $200,000 a month or $500,000 a month for the right to have the insurance against that risk. And after thinking about it for a while, and probably within those banks looking at their models and talking to their economists about the fact that a housing market will never crash in the US, these investment banks obliged those hedge funds until they thought about it for a while and said, I'm on the hook here for $2 billion. Maybe I can sell this to somebody else.
And on and on and on it goes.
Well, and so that's what they did. And the first company, I think it was AIG in London, who had a financial products division, that did this for a couple of years until they went, boy, we're on the hook for $20 billion. And so there were a number of people who were, first of all, convinced that the housing market prices would not go down, that the models absolutely convinced them that these things weren't going to default. And so it was a really good business.
But it sounds like it's based on finding another sucker somewhere along the way to take your risk.
I want to be a little bit careful about that, because in hindsight, sure, it looks like that. But remember, for a couple of years, Mike Berry, I think, is the famous hedge fund manager who really figured out this first. This is written up in Michael Lewis's great book, The Big Short. And Michael Berry almost lost his business. He had a lot of investors saying, what are you doing? You're supposed to be a value equity investor, and yet 50% of our fund is in credit default swaps. Why are you doing that? He says, because I am absolutely convinced we are going to make a ton of money when the housing market breaks down and when the models turn out to be garbage.
And did they?
They did, but it took 2 years to get there. And he was sending his $100,000, $200,000, $300,000 check every month to whoever it was that held the other side of that trade. So these guys, they were in it. You know, their skin was in the game. And you know, in 2005, 2006, it was hard to get people to agree that the housing market was going to go down. And that's why there was such an appetite for it. You had a low interest rate environment where people were anxious to get yield. You had someone come along and say, if you're prepared to take $2 billion of risk that these bonds will default, I'm prepared to pay you $500,000 a month. And you can be sure that they had to send that check in. Guess what? The market boomed. And then it just fed on itself. And it fed on itself because there was this tremendous incentive then to write mortgages. And you had guys writing mortgages who were just mortgage brokers. They didn't have to really worry about who they lent the money to because it wasn't their money that they were lending.
Okay, let's stop it there for today because we got 4 more days to do this and pick up the story and follow the bouncing coins or dollars or whatever, because they sure did bounce all over the place.
They bounced a lot.
Yeah. Thanks, Paul. We'll do it again tomorrow.
Look forward to it.